what are the rules around taxation of ESOPs in India, and specifically at two stages, right? At the time of exercising and at the time of sale. So if you could explain that, that would be a good starting point for this.
Sure. See, at the time of exercise, what happens is, like I told you, the company will have to do a merchant banker valuation to define what the fair market value is at which they're giving you the shares. So now when you exercise a stock option, let's say you're exercising one stock option and getting one share, the exercise price might be usually very nominal. It's usually close to the face value. It could be 10 rupees, 5 rupees, 100 rupees, whatever. But the share price ascertained by the merchant banker might be 10,000 rupees. So you're essentially paying the company 10 rupees to get a share worth 10,000. The government looks at this as a benefit that you've got, as a perquisite, as a income that you've made. So in India, what happens is, because it is very onerous and your entire tax season has not come to an end, you're not really, your Form 16 and all is not there. It is difficult to know what your tax slab is going to be. There is a flat 30% plus a 4% cess that is usually charged. 31.2% is usually the baseline that companies usually compute that individual's taxes on. So let's say you're getting...
So this is basically fair market value minus the exercise price, and 30% of that is what you're liable for. Okay. And that's a huge amount for a lot of...
Humongous amount, right? 10,000 rupees minus 10 rupees, 9,990 rupees per share. So if you're exercising 100 shares, right, that's a lot. That's that's close to 10 lakhs, right?
And you pay 3 lakhs in tax on that.
On that, you're going to pay 31%. So 3 lakhs and above is going to go from your pocket upfront. Upfront, just to own those shares. So how the math would work, if I were to, let's say, exercise 100 shares of 100 stock options at a fair market value of 10,000 rupees per stock option, which is 10 lakh rupees in total. And let's say my face value or my exercise price is 10 rupees, which is the face value, which means for those 100 stock options, I'm going to pay 10 rupees per stock option. So I'm going to pay 1,000. 10 lakh rupees worth of shares, I'm paying 1,000 rupees. 10 lakh minus 1,000, 9,99,000. On that, I'm going to pay 30.1% or 30.12%. Right? 31.2% upfront. So I'm going to pay 3,10,000 plus 1,000 rupees of exercise price to the company. Once that is done, the company is going to send the shares to me. That is how.
So the price of exercising is nominal, but the tax implication of that exercising is huge.
There are tax deferrals, etc., which we'll touch upon in a bit, but it is, and that is the biggest downside of ESOP, is the taxation. That is the only big elephant in the room that you can't ignore when you offer ESOPs. Everybody, if taxation was not a problem, ESOP would be one of the greatest, securities that are issued to people. Right? But it is not, but it can't, right? Because government collects tax. Now, at sale, what happens? Now, let's say I exercised that, I got 10 lakh rupees of the stock option, I paid 3 lakh rupees, waited for another 2 years, let's say I waited for 23 months, and now that 10 lakh became 20 lakhs. If I sell after exercising, once I become a shareholder, within 24 months, any unlisted equity, I have to pay short-term capital gains, again at tax slab. Right? So that year, that remaining 10 lakh rupees of alpha that I've made, on that, I'll have to pay maybe 30%, 40%, whatever is my tax slab. At the end of the year, I'll have to pay taxes on that. But if I wait for a day after 24 months, then I have to pay 12.5%.
Which is the long-term capital gain.
Long-term capital gains. So STCG for unlisted shares is 24 months and below. LTCG is even a day after 24 months. Right? So on income tax slab for STCG, 12.5% for LTCG.
And this tax that you're paying at exercising is what Perquisite tax is, correct? So if you could just focus on this and explain this a little bit. Why is it called Perquisite tax to start with, and what are the implications of it?
Because the government looks at it as a perquisite income, a perk that you're getting, an actual income from, not from salaries or another income that they're looking at. It treats it as that. You're basically getting free shares. See, even when you look at shares, right? So if I gift you shares of more than 50,000 rupees, you have to pay tax on that, because that's considered as an income, right? So when you get this large amount of shares from the company, the government does look at it as free shares that are getting.
While leaving their company, right? And purely from the perspective of taxation, what is a decision framework that somebody will have to use to decide whether they need to exercise or not?
Firstly, I think we'll revisit exactly what I mentioned, that You have to have made all those due diligence checks with the company. You have been with the company, you're leaving the company now. If you're leaving the company because the company is going nowhere, and then you're not going to exercise it anyways, right? So you have to do all this due diligence. You need to firstly do a retrospective of how the company's performed while you're there, how whether you believe the company is going to do it, and all the other checks, quantitative, qualitative checks that I mentioned to pointed out in the previous part of the conversation. If all of them are still a green flag, all of them are ticks, and you think you believe the company is going to do well, then your thesis to exercise is legit, right? You believe in the company. Then you got to see, okay, am I willing to? This is a great company, but am I willing to risk my capital upfront? Now, those questions will be answered if the company says, "Hey, no, we are definitely going to do a buyback." If they have done a buyback already, brilliant, right? That gives you even more conviction that, hey, listen, the odds of me getting liquidity is very high. Only once that assessment tells you that, hey, Rijas, you can take this risk. It is gonna come out of your pocket today. You might have to break some mutual funds. You might have to borrow or whatever you got to do to fund this exercise event, which in many cases, it could be 40, 50, 60 lakhs. It's that big of an amount in many cases. And then if your assessment there is that, no, this company will grow, maybe whatever I put up front, I make multiples of that, then exercise.
From a mindset perspective, what you mentioned earlier, which is while you're evaluating an offer letter, you have to look at this company as a place, as a company that you are going to invest a huge amount in, which is the salary cut that you are taking in cash component. While you're exiting, right, the decision that you need to make is it worth the risk compared to the amount that I'm paying in the Perquisite tax and exercise options? Now, what are some of the common expensive mistakes professionals make with their ESOPs, right? Especially in context of taxation and otherwise.
I think very costly mistakes would be exercising just for the sake of exercising without doing any due diligence. Like just doing it because I have 90 days left, so no, I'll just take some money and put it. All they know is that the company has raised funds and they've done very surface level due diligence. They barely know how the company is performing, if they're doing well, if the founders are on the same page, if the investors are willing to fund them in the next one. They don't know all these things. They simply outright exercise. Second is during the grant phase itself, if you don't really believe in the company and just accepting for the heck of it, you're essentially saying, hey, I'm going to work here in this company and reducing my cash component for ESOPs that I don't even know might materialize to anything. So that is that's actually expensive. People are usually not able to rationalize intangible cash. They're not able to rationalize that. They're not able to visualize it. But intangible cash is where you lose a lot of money. You could have worked at a better company that gave you more cash or give you better stock options. So assessment and lack thereof can be the most expensive when it comes to accepting grants or exercising. Second one would be when you exercise. So if you really believe the company is doing very well and you have 100% intent to exercise the stock options, start exercising them early. Don't wait until all the stock options are vested and the fair market value is kept on rising, because you pay taxes on the difference between the FMV and the exercise price. So if in 12 months, the stock options are vested and you have extreme conviction in the company that they're going to do well, or let's say you've joined a company which does a lot of buybacks, a great candidate for you to do this. If a company has done a lot of buybacks and they keep doing it every year, if you got it vested within 12 months, you might as well just exercise it, because you know that some of it is going to get bought by the company. What happens
And the tax liability is lower in that particular scenario.
Any additional tax liability over that is going to be on STCG or LTCG. So if the company is worth 100 rupees at the end of 12 months, if you exercise it at 100 rupees and let's say your exercise price is 10 rupees, you pay tax on 90 rupees. But let's say now you wait for 3 more years to exercise that 100 rupee lot. That 100 rupee might have become 400 rupees. Now you're paying 400 minus 10 on 390 rupees. But if you exercise it at 100 rupees and you waited for another 2 years to sell it, you would enjoy long-term capital gains of 12.5%. So you would have paid 31.2% on the 90 rupees profit that you made while exercising. But the remaining 300 rupees, you're only going to pay 12.5% on that.
Super. Right? Fantastic. That's very insightful, right? So the key takeaway that I'm at least taking from this is, if you believe in the mission of the company, if you believe in the growth of the company, it is better to exercise it earlier so that your tax liability is lower, right? And that would be a good way for you to, de-risk yourself from paying a higher tax later on. And second, it also gives you like a better chance at liquidation events in the future.
Correct. That's exactly.